You followed the signal, you got in, and on paper, it even worked out. So why does your account still look worse than it did 6 months ago? That is the part that nobody talks about with crypto signals. Sometimes the cost is obvious, a platform that will take your deposit and then it'll go dark the moment you try and withdraw it. And we'll get exactly into that later, but most of the time the signal isn't fraudulent. It's not even wrong. Plenty of them are right often enough that it keeps you coming back. The cost is quieter than that. It shows up in the trades that you didn't understand, the exits that you took late because you're waiting on a message, and the one skill that you don't have after months of winning calls, the ability to read a chart and make a decision for yourself. That is exactly what's costing you money. Not the bad actor, not the bad signal, the dependence. Before we go further, a boundary. This is not a video telling you which signal groups are scams and which ones are legitimate. Some are run in good faith, some are not. That is not the point. The point is what happens to you as a trader when your entries and exits come from somebody else's message instead of your own read of the market. Even a signal from a genuinely skilled trader can quietly work against you. And we're going to look at exactly how. Here's the part underneath all of it, and it's worth saying plainly. Most people are not chasing signals because they lack information. They are lazy about doing the thinking themselves. It's easier to let somebody else make the decision than to do the work yourself. That instinct is normal. It's also exactly what gets exploited and exactly what keeps you from ever becoming a real trader. Number 1, you never build a feedback loop. Skill in trading comes from a loop. You make a decision, you see the outcome, and then you connect the two. That connection is where the learning happens. When a signal tells you to enter, that loop breaks. If the trade wins, you don't know if it was the setup, the timing, or luck. If it loses, you don't know what to fix because you were not the one that was reading the structure in the first place. Months of following calls can pass with zero improvement on your own ability because you were never the one that was making the decision. Number 2, the timing was not built for you. A signal is written for an audience, not for you specifically. By the time you read it, react to it, and place the order, price is often already moved. The caller may have entered earlier with a plan for sizing and exits that was never fully shared. You are trading their setup with different timing, different size, and none of the context that shaped their decision. That mismatch alone can turn a winning call into a loss for you personally. Number 3, you inherit somebody else's risk, not your own. A signal usually gives you an entry and maybe a target. It rarely gives you a risk framework built around your account, your size, or your tolerance for a drawdown. So when a trade goes against you, you end up improvising. That's when revenge trading shows up. Oversized entries, moving stops, adding to losers because the group is still saying, hold. None of that is discipline. It is somebody else's conviction that's borrowed under pressure with your capital attached to it. The math behind this is often way worse than it looks. Traders who've compared notes across multiple paid groups describe a common pattern. Risk-reward set up so unevenly that it can take 5 to 7 winning trades just to offset a single stopped-out loss. A call arriving with several take-profit targets can look like extra opportunities, but often works the other way. It gives you more moments to feel like the trade's going well before it's actually closed, which makes it harder to sit with than just one signal that matters the most, the stop loss. Number 4, survivorship makes a track record look better than it is. Winning calls get screenshotted and shared. Losing calls tend to quietly get scrolled past. Over time, this creates a track record that looks stronger than the reality, and it keeps traders subscribed and dependent long after the results have stopped justifying it. Number 5, it replaces preparation with anticipation. Structured trading means that you've already decided, before price gets there, what you will do at a given price level and why. Signal following replaces that with waiting. You're not preparing scenarios anymore. You're watching a feed. Hopefully the next message arrives in time. That is a fundamentally different mental state and a harder one to trade well from. Put those 5 together and you get the real cost. It's not just one bad trade. It's a trader who years later cannot look at a chart and tell you what it is doing. And the trader still panics without a message that tells them what to do. And they still have not built one asset that actually compounds independent judgment. You don't have to take all of this on theory alone. A trader posted a detail account to r/cryptocurrency after deliberately joining a paid signal group for a month. specifically to document what happened. The pattern matches everything above. The free trial opened with a win, then a string of low quality coin calls with a stated stop loss around minus 25%, but instructions for the group to exit early before the stop loss, which meant the real loss is closer to minus 8% per trade. In the public preview group, only the winning trades were ever posted. Across the month, one loss was shared, at 2% framed as the group saving the day. Over a full 30-day stretch trading the actual signals, the numbers were plain. Around $40 in total profit against $79 in total loss. So a net loss around about $38, even after skipping several of the trades along the way. With 40 paying members at $30 a month, that's close to $1,200 a month in subscription revenue for the group, entirely separate for whether any member was actually profitable. That's one account. And it's not a claim that every single group works this way, but the mechanics it describes, quiet losses, showcased wins, and a fee that gets paid whether you profit or not, are common enough to recognize. The group's income does not depend on your result. It depends on your subscription. It raises a question worth asking about any paid signal service before you join one. If a strategy reliably works, why is the person running it selling access for a monthly fee instead of simply trading it themselves? A genuinely profitable edge does not usually need a subscriber base to be worth running. The moment a trader is more focused on broadcasting wins than compounding them quietly, that's worth noticing. This is not just internet paranoia. In 2025, the SEC charged the operators of several crypto trading platforms and investment clubs with running almost exactly this playbook. They recruit through social media ads and group chats. They pose as financial professionals, promoting AI-generated trading tips to build trust, and then blocking withdrawals once people tried to get their money out. Regulators say that scheme alone moved more than $14 million out of retail investors' accounts. It is not an isolated case either. The FBI's most recent internet crime report puts total crypto fraud losses in the tens of billions of dollars a year, with investment schemes, people promised outsized or guaranteed returns, making up close to half of all reported scam losses. Watch for one phrase in particular, insider trades, or any claim of special, privileged access. Stories describing exactly that pattern. A paid VIP tier promising inside information followed by a large personal loss show up repeatedly across trading forums and community sites. Think through what that pitch actually means. Regardless of any one particular story, if a signal genuinely comes from inside information, then acting on it is insider trading, and that's a real securities violation, not a shortcut to wealth that you should be worth wanting. If it does not come from inside information, and it almost never does, then insider trades is just a phrase that's built to make a subscription sound like an edge it cannot actually offer. Either way, that specific promise is a reason to leave, not a reason to upgrade to VIP. But the tactics that regulators describe, building trust in a group chat, presenting curated wins and restricting withdrawals when it counts, they sit closer to ordinary signal group behavior than most people want to admit. Now, set aside the scam question completely and assume that every signal that you ever followed came from someone who is honest, skilled, and acting in good faith. The core problem is still there. One trader on another forum put it better than most. If you don't know how to generate your own buy and sell decisions, you are not a trader, you are a depositor. And a bank deposit at least comes with some guarantee on your principal. A signal group offers none. No one ensures the outcome. No one owes you your capital back. And no one is accountable when the call is wrong. The real dividing line this video has been circling is not whether a given signal is honest or fraudulent, it's whether that you're actually trading or simply depositing your money with somebody else's judgment and decision attached, and you're just hoping. If your reaction to all of this is something like, fine, how am I supposed to trade if not entirely on my own? That's the right question, and it's one that you should be asking if you've been burned once or twice. The answer is not to trade blind either. It's to build a process where you're the one that makes the decisions and you're informed by real structure. Whereas a signal, if you use one at all, should just treat it more like an opinion to weigh instead of an instruction to follow. One experienced trader on a trading forum put it better than most people manage to. The best signal he ever got was not a call on which coin to buy. It was learning risk management instead of chasing pumps. That's the actual shift that this framework is built around. Not zero signals, zero dependence. You don't have to quit your signals group cold turkey to fix this. You just have to change what role they play in your process. And here's a simple way to start. Step 1. Before you even open a signal, write your own read first. What does structure look like to you? Where would you expect support or resistance? Do this even if it feels rough. This is how that feedback loop starts rebuilding. Step 2. Use the signal as a second opinion, not an instruction. If your read and the signal roughly agree, that is useful confirmation. If they disagree, that disagreement is worth more to your development than either call being right, because now you have something specific to study. Step 3. Build your own entry with your own confirmation instead of reacting to a single alert. Waiting for your own structure to confirm and sizing the position yourself, that's based on your own risk tolerance and leverage, means no single message and no single moment controls your outcome. It also means your risk is sized by you, for your account, and not inherited from somebody else's plan. Do this consistently and something shifts. The signal stops being the thing that you depend on and becomes one more data point that you can evaluate. The same way as if you would evaluate any other piece of information. Following a crypto signal is not automatically a losing move, but building your trading around somebody else's calls quietly costs you the one thing that actually determines long-term results: your own ability to read the market and manage risk under pressure. The fix is not to reject every signal you see. It is to stop treating them as instructions and start treating them as one input into a process that is yours. If you're done outsourcing your decisions and you're ready to start making your own, come and join us at the Crypto Mercenary community. It is where we break down real charts, we work through real risk, and we apply AMS together. We do it alongside other traders doing exactly the same thing as you want to do. Preparation over prediction. That is where real trading skill starts.